it's the end of something big, right? But of course, the end is a long process, and it can be a decade-long process. So I think that basically, with the long-term debt cycle, every several decades, when you reach a massive amount of debt, when you go down to zero interest rates, and you have kind of just massive amounts of debt in the system, usually you go through some sort of currency devaluation and system change, right? So it's not the end of the world, but it's the end of an era, basically. And I think that's something we're seeing in a number of markets. But to get less doomy than that, if we focus more on the near term, we're in a cyclical downturn, and not all cyclical downturns become recessions, but some subset of them do. And so when we look back over the past, let's say pre-COVID, we had like a 10-year long, economic expansion in the United States. We still had 3 cycles within that decade-long period of accelerating growth and then decelerating growth. And it just that the decelerating growth never became negative growth. It never became an outright recession, even though you had a couple of near misses there. And so what we've been in over the past more than a year now is a decelerating growth environment. And then combined with the fact that this one is so inflationary, kind of leading up to that, that this one is becoming more severe and is kind of starting to look like a recession, at least by many indicators. So it does not look like a recession in terms of employment yet, but by most other, especially leading indicators, it does look more recessionary. And tying this into crypto, to the extent that I'm here, historically, when you look at the Bitcoin and crypto bull markets, a lot of people tie it to the Bitcoin halving, which I think is relevant to some extent, but it also actually matches up very, very closely with these economic accelerating and decelerating environments. And so, for example, we can use the Purchasing Managers Index. It's kind of a go-to macro indicator for economic acceleration or decelerating. It looks like a sine wave over time, and they average roughly 3-year cycles. And it just so happens that all the Bitcoin bull runs were during these rising PMI environments, and all of the downward or choppy sideways periods were in declining PMI environments. And of course, that all of crypto kind of goes up and down together, maybe with a little bit of a lag. And a lot of what dictates the PMI environments is also liquidity conditions. And so central banks and kind of dollar liquidity around the world, generally, one of the big questions was, for example, why is Bitcoin not serving as an inflation hedge? And of course, that would extend to any sort of finite token. Why are these things going down when you ironically have high inflation of fiat currencies? And there's actually really good charts out there that show Bitcoin in particular. I use that one because that's what most of the macro people will look at, because that's the biggest, most liquid one. And you'll see that, in rising global M2, so rising global money supply year over year, Bitcoin does very well in that environment. And now we're actually at a period where money supply is growing more slowly than it was a year or two ago. And you have multiple central banks, mainly the Fed, kind of pushing back and strengthening the dollar compared to many other currencies. And so when you translate all that back into USD denominated global M2 growth, it actually kind of came to a standstill. So ironically, now that price inflation is happening with a lag from monetary inflation, and some central banks are actually fighting back, it makes more sense as why we're seeing kind of downward price action in a number of assets, including Bitcoin and cryptocurrencies. Yeah, so global debt cycles are kind of correlated to that global reserve status, but not necessarily the same thing. And so in the last kind of long-term debt cycle, we did see the transition from UK having global reserve currency to the United States. One point I've been making for a while is that, now there's really no country large enough to have the only global reserve currency. That was kind of actually an anomaly that persists in history. It's not something that necessarily has to repeat over and over again, and that I think we're heading towards a more decentralized type of system. And I think that was somewhat accelerated by the events we've seen in Ukraine, right? So you have Russia initiate a war, and then the West responds by cutting off their foreign exchange reserves, and then you kind of everyone kind of realizes around the world at the same time that, wait a second, the money-like aspects of these reserves are maybe not as money-like as people thought, right? If they can be censored, if they can be confiscated, whether or not you agree with the reason, that now gives an incentive to a number of countries to be like, wait a minute, we're holding liabilities of countries that we're not necessarily fans of. What does that mean? What should we hold instead? And so I do think that we are starting to see, for example, gradual shifting away from treasuries by Russia was obviously early to do it. China's been doing it since 2013. Japan has been a big buyer of treasuries, but now they kind of have to protect their own currency, so they're not really buying treasuries anymore either. And you've seen, for example, some of the economic forums, Putin has called for kind of, alternative payment systems, cooperation with some of the other peers, like between Russia and China or Russia and India, for example. India's actually stepped in, even though India's more of a, somewhat of an ally to the West than, compared to China or Russia. They stepped in to buy massive amounts of Russian crude. And so I do think we're seeing a little bit more of a multipolar world emerge rather than a unipolar world. Just kind of a U.S. dominated global order, I think, is shifting into, kind of a more multipolar, multiple centers of power. And right now, the dollar index itself is very strong, but that's in large part because it's heavily connected, it's heavily based on the euro and the yen. And Europe's obviously having a very specific energy crisis, more so than even the rest of the world. And Japan's doing yield curve control with a very tight cap. And so basically, it's one of those things where, it's not that the dollar's weakening right now, it's actually quite strong, but the global demand for it, especially among foreign central banks, is drifting towards that more decentralized model. And if anything, over the past decade, we've seen a mild uptick in gold usage among central banks because, obviously something like Bitcoin or these others are nowhere near big enough or stable enough that for most of them to be interested. And so gold is kind of the self-custodial, inflation-protected asset that they could turn to if they want to, hold money for a long period of time and not have counterparty risk. When macro people debate that theory, the ones that understand it, it's not so much they disregard the theory. The question is, how does that theory end up? And so basically, for people that aren't familiar, the point goes that, United States is global reserve currency. That doesn't just mean that central banks hold it. It also means that it's the currency that most offshore debt is denominated in. So if an entity makes a loan to a developing country, either their government or a large corporation there, they often don't want to do it in their local currency. They'd rather do it in a harder currency. And that could be dollars, euros, yen, things like that. And dollar, of course, is the disproportionate one there. And also, it's not even mostly U.S. entities that are necessarily making those loans. Entities in Europe or Japan or China will go out and make dollar-based loans to, a country in Africa or a country in South America. And so as a result, the world outside the United States has, according to the Bank for International Settlements, something like $13 trillion in US denominated debt. Now that's somewhat offset by the fact that the whole world outside of the US has something like 50 trillion in US denominated assets, right? So the US has run these gigantic structural trade deficits, actually about $14 trillion worth of trade deficits over the past, call it 25 years or something like that. And they take those dollars and then they buy U.S. assets. So they buy treasuries. When those started to become kind of worse investments, they shifted to buying U.S. stocks. They buy U.S. real estate and things like that. They kind of pile it into financial assets. And so when it comes down to the dollar milkshake theory, the point is that if there's any sort of disruption in dollar cash flows, the strength of the dollar goes up dramatically because all of that debt represents demand for dollars. And so they have a short squeeze. They have to buy dollars if they want to cover their own debts or try to service them. Now, where that theory, I think, becomes somewhat self-defeating is that if the dollar spikes too much, like what we're seeing right now and what we saw back in action in March 2020 during the, kind of the worst of the COVID crash, it starts to cause, ironically, a U.S. recession, global liquidity problems, and then those foreign entities start selling U.S. denominated assets in order to get dollars. So you start to get problems in the U.S. Treasury market, illiquidity problems, because the foreign sector stops buying or outright starts selling them in order to get dollars. And so, first it hits other countries, but then it ricochets back into us. And I think that right now we're kind of in that phase where it's ricocheting back into us, and that's an environment where almost nothing other than dollars does well, including U.S. assets, U.S. stocks. Multiple things start selling off, and then of course Bitcoin and cryptos being so volatile and a smaller market, they generally, they're some of the earliest things to fall. They get crushed. But even things like, equities, real estate, gold, just assets around the world sell off because basically this unit of account is strengthening so much and causing kind of forced selling.